Welcome to Catalyst. I'm Madison Mills. 30 minutes into your U.S. trading day. Let's get you those three catalysts we're watching this hour. First up, we'll break down the market action and if Nvidia's GTC conference is enough to kickstart the slagging tech trade. Plus, as the Federal Reserve kicks off its FOMC meeting in Washington, we'll break down what investors want to hear from the central bank. And Netflix getting an upgrade as its ability to monetize is put into focus. We speak to the analyst behind the call later this hour. Half an hour into the start of U.S. trading, let's get you a check on the markets brought to you by Tasty Trade. Taking a look at your major averages, you are seeing continued selling. We had 2 days of relief after 4 weeks of losses, record-breaking losses, the biggest set since 2023. We had a little bit of a moment of recovery. We thought maybe we were out of the woods, but now we're seeing that selling continuing. You've got your S&P 500 off more than 1%, but it's the tech-heavy names that are the biggest laggards today here. You've got your NASDAQ down nearly 2%, the likes of Strategy, formerly MicroStrategy, Tesla, Palantir, the biggest losers for the NASDAQ this morning. But let's flip the board over. Take a look at the bond market. You've got yields continuing to move to the upside, particularly on the longer end of the curve. You had your 10-year hitting near 4.32 this morning, particularly off the back of industrial data showing an increase in domestic production in the U.S. So the bond market continuing to look at sort of the impact of White House policy, potentially increasing domestic manufacturing here. And you see those moves to the upside as a result. But let's finally flip the board and look over at Nvidia. You've got shares down nearly 4% in the trade ahead of that GTC conference. We're going to be continuing to monitor any headlines to come out of that conference. Perhaps we're seeing more selling ahead of any of those headlines, but the tech trade is one that investors are keenly watching as it continues to weigh on the broader averages here. I want to welcome in Simeon Hyman. He is the global investment strategist at ProShares, and he's going to join me here for the hour. Simeon, great to have you here. We're going to kick off our hour with the tech trade. Obviously, as I've mentioned, it's one of the biggest drivers of the market right now, and right now it's driving the market to the downside. What is next for the tech trade?
I want to bring a little history in and maybe just a touch of optimism. I'm going to go back to the end of the last century. Tech was 30% of the S&P 500, exactly the same as today. Tech was 12 times price to book, exactly as it is today. But the PE was 60, and we're getting close to 30 right now. That means that these tech companies are making twice as much earnings per investment dollar as they were back then. It doesn't solve all problems, but it tells you that it is different this time. These companies are cranking out cash flow.
And is the question then just the uncertainty around policy from the White House? Is it about DeepSeek? What is driving the selling? And I want to understand that because I want to understand what will assuage the concerns driving the selling so that I know when we've hit the bottom when it comes to tech.
The uncertainty is certainly part of it. People often ask the question, does the economy do better and the stock market do better under Democratic or Republican regimes? And the answer is the market does best when there's gridlock. So when things move too fast, there's uncertainty. But still, it's still valuation. Even at 32, 33 times, that's a little pricey. The forward earnings multiple for tech is only 25, but they got to get there. So I think there is policy uncertainty, but the growth expectations are still, of course, higher than the rest of the broad market.
So what does that tell you then about investor sentiment and just the degree of pessimism we're seeing? That's driven by valuations in your view, not a fundamental change to these companies.
I think that's a key element, and the way that you can see that is the things that are performing. Now, of course, at the beginning of this year, anything that was light, Mag 7 and tech was in the green. But some of those strategies have started to crack. Things like just simply equal weighting the S&P 500 or value stocks started to go in the red the last 3 or 4 weeks. What's holding up, though, are high quality strategies. For us, we have the S&P 500 Dividend Aristocrat, ticker NOBL. And that's in the green all year, and that's because the fundamentals are actually stronger than the broad S&P 500, as well as part of the broadening trade. So in other words, if you're looking for an alternative in the bargain bin, since everything's on sale, why not buy the quality? Why not buy the luxury goods in the bargain bin rather than the deepest discount? And because that's holding up, that tells me at least part of this is valuation.
So then talk to me about how investors should be thinking through positioning. Should they be considering selling more of their tech holdings to get in on some dividend names for that protection, for that hedging amid more market volatility? Or should they consider buying the dip in big tech?
So I would put it in two parts. First, tech is still 30% of the S&P 500, and practically from sort of an investment policy statement, you wouldn't zero it out unless you're clairvoyant. So sure, mixing in more of the high quality dividend growers, maybe cutting that tech position down from its market weight of 30 to something like 15, absolutely a good idea. But let's not forget that the main defense against stock volatility is bonds. For the first time in a generation, interest rates were high enough now that QE is gone to actually diversify your stock portfolio. The ag is up 2% year to date.
Right.
So folks should not forget about that.
And one final chart to add to some of the optimism that you mentioned I want to pull up is that we are seeing an increase in corporate insiders buying their own shares. This is something that we saw a huge dip on. You can see just at the very end of this chart here, just a tiny little move to the upside in terms of company executives buying stocks amid this broader sell-off. How much of a catalyst do you anticipate that being?
It's a great sign. Look, any time that corporate insiders are confident in their own stocks, because they're so concentrated to begin with, that's a great sign. And of course, it's a good complement to the dividend growth story, because those are insiders who are confident enough to share and signal to shareholders that their prospects are good. It's very different than a buyback. When a company does a buyback, it's telling you it had a good year last year. But when it commits to a dividend increase, it's a positive forward signal. So I take dividend growth and insider buying both as very good indicators. All
right, some good news amid a red day so far. Simeon, thanks so much. Stick with us. You're going to be around for the hour. But I do want to talk about the Federal Reserve, because the Fed kicked off its two-day policy meeting this morning in Washington. Here on what we can expect, we have our Fed correspondent, Jennifer Schomburger. Hey, Jennifer.
Hey, Maddie. The Federal Reserve widely expected to hold its benchmark interest rate steady when it concludes its two-day policy meeting on Wednesday. But the bigger question is how President Donald Trump's policies could change the Fed's outlook for the economy and thus setting interest rates. With so much uncertainty surrounding Trump's tariffs, the central bank is likely to strike a cautious note. Fed Chair Jay Powell is likely to reiterate that the Fed is not in a hurry to cut interest rates as it awaits clarity on the administration's policies and their impact on the economy. Investors will receive the Fed's latest interest rate projections, which aren't expected to change much. In December, the Fed projected 2 rate cuts for this year, and many Fed watchers expect officials will retain that outlook for now amid uncertainty, even as the market is pricing in 3 cuts for this year. Former Kansas City Fed President Esther George says she thinks Fed officials will maintain 2 rate cuts because officials already set expectations and explained that the cuts could come later this year. George says it's, quote, not the time to cut rates at this stage, noting that the Fed has an inflation problem, too. George says she thinks tariffs could hurt growth, but also says they could push up inflation. And New York Fed President John Williams also said earlier this month he thinks that tariffs could contribute to inflation. Investors will certainly be looking for whether the Federal Reserve decides to increase its outlook for inflation while lowering its outlook for growth. Goldman Sachs projects that the Fed will increase its outlook for inflation to 2.8% this year from 2.5%, while dialing back its outlook for growth to 1.8% from 2.1% because of tariffs. George, for her part, says that when Fed officials look at the outlook for the economy, they could be growing more worried when they model out what the tariffs mean. Maddie?
All right, Jennifer, thank you so much. As always, coming up, we are taking a look at today's trending tickers, what to expect from Netflix following a huge upgrade for the streamer. That's next on Catalysts.
Recent market action points toward the need for a new playbook when it comes to the best days and times to trade in stocks. But for passive investors, maybe we have some good news. I'm Jared Blickery, host of Stocks in Translation, and let's take a look at some of the best times to trade. And we're going to start with the concept of seasonality, which I've defined before, but these are recurring patterns in the market that tend to happen in calendar years, but they can also happen each day in the market. So we're going to look at weekday seasonality and specifically how it has evolved over this 2.5-year bull market. And so this goes back to October of 2022. And I'm going to break down, if you had only been invested in the market on Mondays or Tuesdays, Wednesday, Thursday, Friday, that's going to show you this total here. And this is in SPY points. And by the way, this is as of last Friday. So let's take a look at Monday here. Monday has been by and large bullish, but recently, and this is coincidence with the downturn that we've seen in the general market, it has been fairly bad for markets. Now, yesterday was an exception, and I think that's notable too. But it's important to notice these big changes in character for the market. So that's Monday. Let's take a look at Tuesday. Tuesday has been kind of flat recently, but you can see it's been worth 24 net SPY points since October of 2022. But what you can also see here is the trend over the last few Tuesdays has been to the downside. And today we're also going down. And so it'll be interesting to see if by the close we're able to buck that downtrend similar to how we were Monday. Now, we want to take a look at Wednesdays as well. Wednesdays are actually negative over this entire bull market. Part of that has to do with the fact that Wednesday, that has Fed days. And guess what tomorrow is? It's a Fed day. Back in December, we had this big negative reaction to a surprisingly hawkish Fed, surprisingly hawkish Jay Powell. And we'll have to see what happens tomorrow. But that could also be a factor in the market. And that's going to be a big one for these Wednesdays. Now, Thursdays have been heading down recently as well. Helped in no part by CPI. That was a disappointment last week, and here we can see Thursdays and Mondays. That's what I'm circling here, the orange and the white. Those have kind of traded down over the last few weeks together. Now, it'll also be interesting to see if Thursday, when we finally have that first big reaction after all the Fed news is known, what happens and are we able to buck these bearish trends? Finally, Fridays have actually been positive recently. We can see they've turned up over the last 3 weeks. They have been helped by non-farm payrolls, the monthly job reports, and so that has been a boon to the markets. And in fact, you can see that Fridays have been the best day to be in the market with 91.41 SPY points there. Now, I've also broken this down in terms of times of day. And so I've broken the intraday action, 9:30 to 4 p.m., into 3 different parts. And then we have the entire overnight portion, and that's in orange here. And what you can see, and this goes back to 2022 as well, that the gap, the overnight action, has been by far and away the biggest contributor to the stock market gains. And that's simply because the stock market is only open 6.5 hours a day. That means it's closed 17.5 hours a day. And that's when a lot of news comes into the market. So what's been suffering recently is the overnight market, but not in a big way. And also, I would add that the 9:30 to 11 a.m., that early trading action that we've seen some big reversals, and that has been bearish overall for the market direction. So you put it together, and I did say there's some positive news for passive investors here. The good news is that if we were in the midst of a bear market, if we were seeing capitulation selling, we would see a lot more distress in the overnight gap. People coming in Monday would be selling off, and we'd be selling off Tuesday, Wednesday as well, perhaps. And we'd also see a lot more selling in the intraday time frames. So put it all together, the market is in a potential place for a rebound here. Maybe this is going to be day 3 of that, but a little bit of wait and see here. So tune into Stocks in Translation for more jargon-busting deep dives, new episodes on Thursdays and Tuesdays on the Yahoo Finance website or wherever you find your podcasts.
All right, Jared, thank you so much. It's now time for some of today's trending tickers. Scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Capital One and Discover falling on reports that the Department of Justice has concerns about the company's $35 billion merger. According to the Capitol Forum, DOJ staff are worried about the deal harming competition. The merger, originally announced in February of 2024, was expected to close early this year. And next up, Google parent Alphabet announcing a $32 billion all-cash deal to acquire cybersecurity startup Wiz. The deal will be Google's largest ever acquisition. It's part of the company's efforts to boost cloud security. Once the deal closes, Wiz will join Google's cloud unit, while its products will continue to be available across all other major cloud services. Still with me, Simeon Hyman of ProShares. I was just reading the Wiz blog here. They say the partnership is like attaching a rocket to their backs when it comes to cloud security. Obviously, the biggest deal ever for Google, the biggest M&A deal that we've reported year to date. What does this tell you about the path forward for M&A? Do you anticipate more deal making this year?
People always say, well, if there's a little bit of a downturn in the equity markets, then M&A is going to pick up because folks are waiting on the sideline. The acquisitions are a little cheaper. Sometimes it works, sometimes it doesn't work. I'll put myself in the camp of seeing some upside to M&A activity, but for a different reason. Corporate balance sheets are incredibly strong. This is an all-cash deal. If you look at the S&P 500, leverage is at near all-time lows. Net debt to EBITDA is the classic measure. It's 1.5 times. That's down from about 5 times. So companies have lots of room to spend money. And if they don't have all cash, you got tight spreads in the bond market. So spreads are attractive for folks who want to borrow money. So I think the horsepower is there, the ammunition is there for M&A activity.
And to your point earlier on valuations, Alphabet actually the cheapest of the Mag 7 at 17 times earnings when it comes to their forward 12-month PE ratio, which I think is interesting context here. But David Kostin this morning over at JPM lowering his target lowering his target for M&A this year from 25% down to 7% in terms of growth. What do you think is driving that pessimism about deal making, given there was so much optimism right after the election, and now there's a little bit of a downturn in that growth expectation? Yeah,
I'm not sitting with Kostin, but I would imagine that decline is due to the regulatory and tariffs and all of the uncertainty in Washington. So I think if any of that calms down, and it doesn't have to calm down entirely, that would certainly remove some of the barriers towards M&A activity. And that to me is the real only wild card right now, because the economy is still in okay shape and companies have these great balance sheets.
Right. All right, Simeon, thank you so much. We appreciate it. We're also watching Netflix today, upgraded from neutral to buy at MoffettNathanson. Here now we've got Robert Fishman. He's MoffettNathanson's senior analyst. Thank you so much for being here, Robert. You raised your price target to $1,100 for Netflix. Talk to me about your bull case.
Yeah, the bull case is that the more we dug in on this company and refreshed our view, the more confident we got with the growth outlook. And that's going to come from a few different ways. The core business is still really firing on all cylinders. The advertising business and the unlock that happened with the advertising tier is still in the very early stages. And margins, because of all of that, are going to continue to rise. And we don't really see any sort of cap in sight.
And it's interesting, you mentioned that they are the clear winners of the streaming war. Talk to me about how you came to that decision. What was it about Netflix that made you so determined to say that they were the clear winners against competitors?
Yeah, I mean, I think that the reality of that has been clear for probably a couple of years already. And the more that they grow well above the peers and where the other competitors are trying to strive to get to, the more that they have a lead. And we see that with the engagement. We've seen Netflix engagement just continue to be very strong, not just in the US, but around the world. And that's the other piece that really puts them well ahead of all of their peers. The international subscriber base is just unparalleled compared to any of the other companies. So when you put all of that together, they clearly have won, as I think most people know. And the lead that they have is just continuing to expand.
You know, Robert, Simeon Hyman, how are you? I'm the old guy in the room, and I remember a book in the late 90s called The Innovator's Dilemma. And what it said was that incumbents actually have a huge advantage whenever there's disruptive technology, because the incumbents just can't get their arms around it. Their cash cows are too valuable. This seems like we're living in the upside down, that it's incredibly hard for any new entrants to get into many of these markets, whether it's Netflix or other parts of the technology space.
Yeah, I mean, I think Netflix clearly has proven that it has a significant first mover advantage in this streaming world. And I guess as part of what you just said, the traditional media companies have been trying to protect their linear cash flows for many years. But I think there's finally a reality that they can't protect that anymore because of the disruption happening with cord cutting and advertising shifting to online and connected TVs. So Netflix is in a really strong position to capitalize on all of that. And they actually get the benefit of getting content from the traditional guys looking to sell and license their content to stronger players.
How do you think about how much pricing power they do have, just given the fact that in the context of what we're talking about, they have this first mover advantage, but customers got used to Netflix as a cheaper alternative to cable? Does that put a cap on how much they can raise prices?
So it's a really interesting question, and one that we've tried to dig into here, because there's two ways to view it. One is exactly what you said, the premium pricing on the non-ad tier has gotten to the point where it might start to raise questions whether some people can afford to keep paying higher and higher pricing, especially with the highest price in the US at $25 a month. But at the same time, it goes back to that advertising tier that we talked about at the beginning. It really unlocked a whole different potential for them, which was essentially, you can view that as a price cut because it allowed a whole different subscriber base to come in with this advertising tier at a real significant discount to where they were priced before, and even where a lot of their competitors are priced.
And Netflix, like the rest of the market, has been under pressure in recent weeks. It's down about 10% over the last month. What do you think is driving that selling? And is that key driver of selling in Netflix something that you think is going to be resolved long term?
Well, yeah, I mean, as part of our upgrade, we clearly now believe that the upside opportunity is not fully reflected within the current valuation. It did give us an opportunity to come in here at a little bit of a discount. So we tried to take advantage of that. But at the same time, the long-term growth perspective and the fundamental strength that we dug into here really gave us the confidence that the growth is not just for the next year or two, but clearly they have a path to continue to grow well above their peers. And when you look at the valuation relative to that growth, it's a pretty attractive entry point.
But why do you think it's down 10% for the month? Is that just the macro?
I think there's clearly macro questions that are being raised. You guys were speaking to some of them. So again, this is not just a short-term call. This is a longer-term call, basically backing the winners within the industry and the positions that they have.
All right, Robert, thanks so much for joining us and breaking down your call on Netflix. Really appreciate it. We're going to have all your markets action ahead, so stick around for more. You're watching Catalysts. After years of underperforming, Chinese stocks are rallying to start 2025 as economic data points to some resilience. Hong Kong's Hang Seng Index massively outperforming the S&P 500 year to date. So could investors find opportunity specifically in Chinese tech stocks amid fading U.S. exceptionalism? Joining us now, we got Brendan Ahern, CraneShares CIO. And Brendan, it's great to speak with you. Listen, we've heard it loud and clear at this point. U.S. exceptionalism is starting to unwind. You're seeing opportunities abroad in the likes of China. Where would you say is the single biggest opportunity for investors who are interested in the Chinese tech trade?
Yeah, certainly we believe that real opportunity is around the domestic consumption that the Chinese government has recently announced that they're really going to push the pedal to the metal when it comes to domestic consumption in China. So we really like the e-commerce companies. Obviously, there's a push for technology resilience in China, including AI and semiconductors. So we think that we're very well positioned at CraneShares to capture that. Obviously, our flagship ETF, KWEB, is significantly outpacing U.S. equities year to date. But I really think it's important to go back to when Chinese equities bottomed in January of 2024, where the outperformance versus U.S. equities is very, very significant.
And talk to me, too, about some of the individual names here, because you sent over your top holdings, and a lot of them our audience is going to recognize. You've got your Alibabas, your Pinduoduo, JD.com. But talk to me about the opportunity and some of the lesser-known names that investors should be keeping an eye on.
Yeah, there's a whole host. I mean, to your point, people know the Tencents and Badu's and Alibabas, JD.com, but there are some really interesting companies in the online video space, companies like Huashu, as well as Bilibili, a little bit lesser known here in the U.S. because they really don't do any business here in the U.S., but very much geared to the younger generation in China, really the gaming community. Those companies are really, really pushing in online video, social media, but increasingly that incorporates AI as well.
Brendan and Simeon, good to see you virtually. Here's a little bit of a kind of big picture question. If you go back 20 or 30 years, I think there was an assumption that as China got wealthier, they would become more free and more like the US. And it turns out that doesn't necessarily seem like it's happening. Now, let's put that into context of the tariffs. One of the kind of real, I shouldn't say real cases, but very justified cases for tariffs is when you're competing as a free economy with a country that isn't a free economy and the government's pulling a lot of levers. And yet today we see the focus is not so much on China. Does that mean we as the US are accepting where China is landing as a country?
Well, I mean, first and foremost, the U.S. and China are highly intertwined economically. I mean, if you don't want to hold China, that means getting rid of companies like Apple, Boeing, Starbucks, Nike, as well as a whole host of U.S. as well as global CEOs will be in China next week, meeting with President Xi at the China Development Forum in Beijing. So getting rid of China is going to be really hard to do because of the revenue exposure of U.S. and global multinationals. And I think ultimately the U.S. and China, just as we heard from President Trump last night, that he mentioned that President Xi will visit Washington, D.C. in the not too distant future. And I think we have a very non-consensus view that under President Trump, unlike the previous administration, U.S.-China relations can actually get better, something that really didn't happen, right? There was no communication, there was no dialogue, and we're seeing a very high level of discourse between the two governments already.
How do you anticipate the tariff tit for tat impacting the trade more broadly here when you think about any potential ratcheting up of these tariffs? What are you kind of factoring into your models about where Chinese stocks are going to go from here, given the unfolding of what could turn into an even more tense trade war between the two countries?
Yeah, I mean, listen, like 2/3 of global market cap is U.S. equities. China is less than 2.5%. So I don't think anyone should worry about the impact of U.S. tariffs on Chinese equities because the ownership levels are so small. What people should be very worried about is what is the consequence of U.S. tariffs on the U.S. consumer, right? We are a service-based economy. And if you think about companies like Walmart, Home Depot, Costco, those companies are heavily dependent upon imports from China. They're simply going to pass along those tariffs, which is really ultimately a tax on the consumer. So I think, you're seeing probability for higher inflation, slower growth here in the U.S. because of a self-inflicted tariff policy.
Brendan, I don't know the answer to this question, but I know in the U.S. domestically, we've been very focused on the fact that the technology sector is much higher quality. All the fundamentals are better than they were 25 years ago. Is that similar in the Chinese tech sector?
Yeah, we're seeing a little bit of a re-rating at the moment where I think kind of the DeepSeek moment really showed that Chinese companies are innovating on their own despite the semiconductor restrictions from the previous administration. The stated effort to hobble and cripple China economically and technologically didn't work. DeepSeek definitely proves that, and we're seeing a whole host of other companies moving up the scale. So we're starting to see this re-rating from a valuation perspective show up on the China side. I think arguably you're seeing that in the U.S. tech companies falling, where you have companies trading at 40 times sales. That's really hard to justify when you have Chinese companies who generate more income on a quarterly basis than some of those companies do on an annual basis from a revenue perspective.
Really great overview of those Chinese tech names, Brendan. Thanks so much for joining us. Come back soon. Thank you. Coming up, Bitcoin currently trading just above 81,000, down a little over 1.5% in the trade today. We're going to discuss the outlook for crypto more broadly with an industry insider coming up next. Investors have retreated from Bitcoin ETFs over the past few weeks, pulling more than $5 billion from the funds. The record run of net outflows coming amid a weak start to 2025 for Bitcoin, down more than 12% year to date. Joining me with more on the outlook, we've got Rich Rhines. He's the founding contributor at CoreDAO. That is a blockchain initiative designed to enhance Bitcoin's utility in the decentralized finance space. Rich, thanks for coming in studio. We appreciate it. I just want to start on the selling that we are seeing in Bitcoin. What do you think is driving that, and how do you anticipate it kind of resolving itself moving forward? What's next?
So if I go back to November, I think we really pulled forward a lot of the expectations, right? And people got overexcited about the Trump election, the strategic Bitcoin reserve. Like people were expecting the US to start buying Bitcoin, right? And that was kind of the trade that people were putting on. Then we throw in some macro pieces with the tariffs, right? Things have pretty quickly shifted there. And I think with the SBR, it's super exciting to have a nation like the United States say, hey, we're going to hold this asset and potentially find budget neutral ways to go acquire more. Like that's all very exciting. But what the market wanted was, hey, we're going to go open market, buy Bitcoin, right? And start this like kind of Bitcoin space race. That, of course, was not true. And I think you're seeing kind of natural selling as a result of that. And we're also seeing ETF rebalances the opposite way, right? Like what we saw throughout 2024 was more and more buy flow, reflexively, positive impact. Now you pretty much have Sailor as kind of the only real bid, as these are kind of countervailing forces the other way as these readjust downwards.
So what resolves some of the pressure that we're seeing here? Is it news from the White House about the SBR? Is it something causing more comfort when it comes to the tariff question in the room? What leads to more buying?
So I think a lot of this is just uncertainty, right? The market hates uncertainty, and I think this is a tried and true story we've seen time and time again. I think maybe by Q2, Q3, sometime in that realm, we see Bessent and Trump start to change, probably go back a little bit in some of this more aggressive policy. And I think then we'll start to see more and more Bitcoin buying start again. But I think right now it's kind of a classic period of accumulation. We're also seeing maybe the death of the 4-year cycle. There's many people that were very excited about 2025 being really that run up. Now maybe it's more elongated, and we'll see 2026 maybe be one of those years. But I think net volatility is a gift in Bitcoin, and it rewards long-term patience.
So I'd be remiss if I didn't mention that ProShares had the first Bitcoin-linked ETF, BITO. It's still a 40 Act, the rest are grantors, and we still got $4 billion in the suite. But here's something that I think is interesting. People think that Bitcoin is just a risk asset correlated with stocks. We would argue not necessarily so. I mean, remember when the regional banks, the crypto-linked banks went under, 2 of them went under, Bitcoin went up. What do you think drives when Bitcoin acts like a risk asset and when it does its diversification job?
It's a great question. I wish I had a crystal ball for you on that. I do think when you get to general periods of like instability, that's where Bitcoin can really show itself, where again, banking crisis going, is a great example where you saw, okay, maybe we need to go an alternative traditional financial system. That's what Bitcoin was, originally promoted to be. When you get to tariffs, it's a different type of uncertainty, right? That's more like macro driven. It's a little different. It's not quite like instability of the sector writ large. And that's kind of how I'd characterize it today, but I don't have a perfect crystal ball for you on that one.
Do you view Bitcoin as a diversifier, to Simeon's point, or do you view it as the key to your portfolio?
I am a very bad example from this point of view. I've been in Bitcoin since 2013. I've been full port since. But I think as of now, it's a return enhancer for most. And I think what we saw was the original 1% allocation is now probably a 10% allocation for quite a few folks. And it will continue to see that grow more and more. And I do think it will become more and more of a core part of most people's portfolio. I think we've seen BlackRock, recently update to 2% from 1%. So we'll continue to see that move more and more. And I think historically there's been a negative carry with Bitcoin, which has been really difficult for a lot of folks, which has been, okay, just gonna have to sit on this pet rock and it's been great digital gold, but maybe it doesn't really do too much more for me. Now with solutions like Core, you can actually have your Bitcoin earn passive yield. So you actually are adding more and more Bitcoin as you go, and you continue to build that position on top of that upside volatility. That's a really powerful combo.
You mentioned the yield aspect. I know you said Bitcoin is your main dealio, but how should I think of that? How should people think about in comparison to the staking yield in Ethereum?
So this is a very interesting, kind of net new concept that Core helped bring to the world with the advent of Bitcoin staking that we brought to market early last year in April. And the idea is it is the parallel to Ethereum's proof of stake. Bitcoin itself doesn't have native yield, so you have to work with a group like Core to help provide that. But this is really what takes Bitcoin to the next level, if you will, which is we saw these spot ETFs. People got so excited about it. We saw massive inflows. We blew out all the analyst expectations. The next level of that is going to be Bitcoin yield products. And we had the first yield-bearing ETPs. We're going to have the first yield-bearing ETFs after we see probably the Ethereum ETFs sometime later this year. And that's going to open up Bitcoin structured products, Bitcoin derivatives. And that's really the most exciting Wall Street story of the next decade plus, as we kind of get to run back the playbook from the 80s and 90s. And so much of this will be net new, interesting product innovation from the Wall Street, big banks, et cetera. And it's a really exciting time to be in Bitcoin.
If tariffs are putting pressure on Bitcoin right now, but there was also all of this optimism about the Trump administration and how it was going to be friendly to crypto and Bitcoin. Is this administration net positive or negative for Bitcoin at this moment?
I think super positive. I mean, I think it was promises made, promises kept. And I think the SBR, for most people that were crypto native, were not expecting open market buying. And I think this actually is a good next step to get these various pieces of regulation that we need. So we've already seen the Genius Act with the stable coins, and I think we will get a market microstructure bill sometime during the Trump presidency, which is so important at helping to ensure that the US is the home of crypto innovation, not just during the Trump administration, but from here forward. These executive orders are really exciting and enticing a lot of ways, but those can always be undone, right? And that's what the Trump administration has, hopefully promised will bring forward is actual regulation that will be put into law and then will be here for up forward.
All right, Rich, thanks so much for joining us. Appreciate it.
Thanks for having me.
Coming up, we're going to take a look at what investors should expect from the auto world with tariff uncertainty looming. We'll have that for you next on Catalysts. President Trump planning to announce a slew of reciprocal and sector-based tariffs on April 2nd. But according to reporting from Bloomberg, U.S. Trade Representative Jamieson Greer is attempting to take control of that announcement and the administration's broader trade policy. Here with more as officials attempt to balance the president's protectionism and business-friendly tax cuts and deregulation, my Capital Gains co-host, Rick Newman. Rick, always so much to speak about when it comes to tariffs. So there's this reporting from Bloomberg that Jamieson Greer, he's going to, take the reins here. He's going to go back to sensible tariff policy, ask business leaders for feedback. I would think that would be positive for markets if markets believed it. So far, it seems like they don't because we are reversing some of the gains that we had seen earlier this week. What are you looking at?
Well, for anybody who's not keeping track of all the Dramatas personae here, here's what's going on. Jamieson Greer is the U.S. Trade Representative. That's the person who is supposed to be in charge or at least manage trade policy. That was Robert Lighthizer in the first Trump administration. He just got confirmed by the Senate, so he's just coming on board. In the meanwhile, it's not like Trump has been waiting to roll out tariffs for the USTR to show up. He's obviously been putting tariffs on China, Mexico, Canada, and so forth. So this has been a combination of Howard Lutnick, the Commerce Secretary, Peter Navarro, the economist in the White House, sort of like the trades are in the White House. So now the reporting is that Jamieson Greer is going to bring some order to this whole process. I mean, in case anybody hasn't noticed, the tariff rollout has been kind of chaotic and disorganized. It's a new tariff here, a new tariff there. Markets consider, investors are saying if a day goes by when Trump doesn't say anything about tariffs, that's a good day in markets. I guess the idea is that Jamieson Greer, the new USTR, is going to bring some order to this process.
And he hadn't been confirmed.
That's right.
Until the end.
He just got there. Yeah.
He just got confirmed. So then how much truth do you think there is to this idea that he is going to lead to some great clarity in Trump's tariff policy?
Maybe in like 3 or 4 years. Okay, I'm being a little facetious there, but I think let's say in 3 to 6 months, there might be something you could call a plan you can look at on a piece of paper. I mean, it might be several pieces of paper, but the other big thing that's coming, and if you're getting tariff fatigue, don't blow this off, because these so-called reciprocal tariffs coming around April 2nd are probably going to be a big deal. This could be the biggest set of tariffs that we've seen so far. And this is literally going to be a country by country tariff regime. And we don't know if it could be all the way down to the level of specific product categories. And we're talking about literally possibly thousands of new tariff rates based on what the product is, where it comes from, and so forth. So this is going to get even more complicated than it is already, and we're going to get more tariffs. So if Jamieson Greer can help provide a sense of order to all this, at some point that will be good for markets. But markets are not going to like the April 2 tariffs.
In the previous administration, we started with the honey. We got deregulation, some tax cuts, and then at the end we got a little bit of tariffs. And now, of course, we're going in the upside down. Any sense on when we'll get a little bit of color on deregulation and tax cuts that people were kind of pricing in when right after the election?
I think there is new urgency in Congress to start making tangible progress on tax cuts, because I think Republicans get it. We need to give the markets something they like instead of all this chaos and higher costs. But it's just not easy getting that tax bill done. I mean, it's very complicated. I think the betting is third or fourth quarter 2025 is when we're going to see that tax cut bill. Here's the catch. Most of the so-called tax cuts are just going to be extensions of the rates that are already in. So it's not like anybody's taxes are going to go down from that. There could be a few additional tax cuts, but for markets, they're going to be small. I mean, no taxes on tip. I mean, that's not really going to move the stock market. So I'm not sure there is going to be this big stimulus effect from basically a continuation of the status quo by the end of the year.
Yeah, the market wants to see additional corporate tax
cuts in particular.
Probably
not coming.
And that may not be coming, according to our very own Rick Newman. Thank you so much for joining us on set, as always. Well, according to the New York Times, earlier this month, President Trump told top auto executives at GM, Ford, and Stellantis to buckle up for those additional tariffs. Our next guest estimating that to shift all auto production to the U.S., it would take a $50 billion investment from the industry. So how should investors be approaching the auto sector with all the volatility? Joining us now, Kurt Hopkins, MCQ Markets CEO. Kurt, great to have you on here. Talk to me about the backdrop right now when it comes to car manufacturers, just given all of the volatility that we're seeing, the impact of tariffs. What are you looking at?
Well, for car manufacturers, it is a lot of uncertainty, and especially in North America here, where we have a very tightly integrated supply chain. The ecosystem of manufacturing is very extensive, and so as the stat says, it could be up to a $50 billion investment to bring all the manufacturing back to the U.S. There'd be a 75% increase in capacity and hiring new people, so it would be substantial. And then on top of that, you have to understand and think about all the other parts. So for example, if there is a tax put on aluminum, of which 70% of our aluminum last month came from Canada. This is the raw aluminum, and a lot of it goes into automobile manufacturing. If that comes across as well, and then that would take decades probably to build those smelters. And in order to generate the electricity to power those aluminum smelters, you would need to build another 4.5 Hoover dams. Yeah. So there is a lot of shifting going around. So I suspect not all that will happen because it would add a lot of cost and a lot of complexity to that supply chain.
Yeah, a lot of cost that would potentially be passed on to consumers. But from an investor perspective, how should investors be thinking about whether or not to buy or get out of auto stocks given the uncertainty surrounding tariffs?
Well, what we are finding for investors is that people in the collector car industry are actually investing more. And so the Trump tariffs haven't scared the car collector side. So this is the part of the car industry where assets actually increase in value. And that's what we also see on our platform at mcqmarkets.com is that people do like to come in and to invest in these alternative assets where you can get a decent return. In fact, over the last 10 years, collector cars in general have gone up 185%, so sometimes beating the S&P 500. So alternative assets, I think in general for a lot of investors are very, very attractive as a way to diversify and move away from the volatility, as well as have a bit of fun.
You know, tariffs are nothing new in the auto industry. I mean, people forget that one of the reasons U.S. pickup trucks have such a big market share is that we got special tariffs on the Japanese trucks. Remember the little Subaru car truck from the 70s that tried to avoid it? I'm just thinking out of the box here, like, suppose there were no tariffs. Does anybody really have a competitive edge that isn't really kind of driven by either tariffs or government subsidies today?
Well, I think some of the competitive edge is obviously around where you have a good labor supply, where you have massive plants built. And so clearly from the North American context, that market has been relatively protected and operated more or less as one market with NAFTA and the follow-on agreements. So I do think that over time, a lot of it could be brought back. But it just needs time and a lot of planning. And so, governing by tweets, it probably doesn't work for the auto industry.
Final minute here. I've been tracking a lot of the investment we're seeing in China. This morning we have Li Auto unveiling their new autonomous driving framework. You've got a lot of positive headlines on Chinese EV makers in particular, especially when compared to the likes of Tesla. Are we getting to a point where China is outpacing the U.S. when it comes to car innovation and technology? And if so, what does that mean for investors?
Well, I think that is potentially very, very true. And one of the issues is I think the whole debate around EVs and climate tech and climate has been a bit of a distraction. While at that time, it's really a tech place, the tech stack. Mm-hmm. And now we're seeing where the CEO of Ford recently said he'd like to copy the Chinese tech stack on EVs. That is probably not what we want. And so I think we need to look really closely at keeping that tech stack for EVs here in the U.S. because people spend a lot of time in their cars, and cars are more than just moving around. It's all the auto experience, everything. So it is a massive experience. So I think for investors, keeping a close eye on EV stocks is very, very important going forward.
All right, Kurt, thank you so much for joining us. Appreciate it. And also, Simeon, thank you so much for joining me as my co-host for the hour. Really appreciate you. Coming up, we've got Wealth. It's dedicated to all of your personal finance needs. Our very own Brad Smith, he's going to have you here for the next hour, so stick around for more.